David Spika is Chief Market Strategist at Turtle Creek Wealth Advisors. David, as always, good to see you. Are you concerned that the market has too much speculative froth in it, or is something else bothering you?
Well, the last conversation you had was very instructive. If you'd asked me 6 months ago, I'd have said, yeah, this feels a lot like 99. But as we've moved further through the cycle, it is starting to feel more like 95. This immaculate disinflation that's coming about without a recession, and it doesn't look like we're going to have one now, is clearly fueling the market. So broadening out would be nice. Generally, in a recovery, you have small caps outperform. We're not really seeing that yet. But you know what? Turn back the clock a year. Let me tell my clients to load up on the Mag 7. I'd look like a genius. But today, it's really, really hard to bet against this market. And I think you have to be invested.
Have to be invested, but you're steering a little clear of the Mag 7 and toward more sort of consumer discretionary or stolid names like Visa and Caterpillar.
That's right, Tyler. At this point in time, when you're looking at companies in the market and what has the best opportunity to outperform over the next 12 to 24 months, you really have to consider valuation and you have to consider macro tailwinds. Now, a company like Visa has tremendous macro tailwinds because of the broad consumer strength, not only in the U.S., but we're starting to see it around the globe. Consumer spending is going to continue to be strong. Visa will benefit from that. They're going to grow earnings at 13 and 14% this year. A very, very solid, consistent grower. Caterpillar is a more defensive name, but they're going to benefit from increased demand for commodities. And we're going to see that as EVs start to gain traction more and more, and as we see global economic growth rebound, particularly coming out of China. So a couple of names that are not represented in the Mag 7, but both had really good recent quarter earnings results and have a lot of optimism around earnings growth over the next 12 months.
And, of course, we love when folks like yourself name names. But just to go back to this idea of the rally needing to broaden out further, what is going to be the catalyst for that to happen? Is it rate cuts? Is it the dollar starting to weaken at some point, which I know is related to rate cuts? Is it something else?
That's an excellent question, Morgan. So what we saw in the fourth quarter is when the Fed started to take more rate cuts off the table and really started to pivot, you started to see the market broaden out. And I think then it was more, okay, we can start buying some of these names that don't have as strong an earnings growth opportunity and that maybe have a little more of a longer term play in them because the Fed's going to help us out. And so I think that's part of it. Once the Fed starts cutting rates, what probably won't be till May or June, I think you're going to see more optimism around the broad market in general. And you won't see people wanting to own the names that have outperformed over the past 12 months and that have that really, really strong earnings growth. You're going to see more demand for a variety of companies in an environment where stock picking is going to pay off.
You say you'd like to see small caps start to participate more. Do you think they will?
Well, if they don't, Tyler, that's going to be a red flag. Because one of the things that's going on right now is we're seeing interest rates rise more than anybody expected. In fact, big part of the bullish story is lower interest rates. We've seen 3.5% 10-year yield expectations from a variety of places. And we know the Fed is expected to cut rates 3, 4, 5 times. That needs to happen. And if that happens, then we're going to see a true recovery rally. And in a recovery rally, investors seek more risk, kind of like what I was saying earlier. They want to own more risk. Small caps, emerging markets, some of these more risky parts of the market should benefit. And that'll be the sign that we are truly in a recovery rally and the investors have a lot of confidence about what's coming up.